Thanks for joining us. The next edition of Market Matters. Today is December 6th, 2022. And here is our rough agenda for today, following similarly to previous episodes. We'll give a brief look at the economic situation, touch a bit on 2022, and that would maybe extend into the early part of 2023. We will do a little bit more in-depth look at 23 in our January Market Matters. At that time, we'll also be introducing some of the capital market assumptions we're making, because that does help frame where we're looking at deploying capital and in what amounts across the portfolios. So please tune in for that. And finally, we'll do a quick iteration on portfolio construction. It just basically means how are we putting the pieces together between the various components, so stocks, bonds, alternative assets, private markets, and cash. And we won't spend too much time on that, but I just wanted to give everyone a brief understanding of what might be involved in that process. So with that, let's get going. So first, let's take a look at the economic update, because this does help give us a baseline around which to maybe inform where we should be looking and what type of aggressiveness we should be taking in portfolios. I do like showing this chart because it's a good reflection of the cross-section of the two major components of the economy, which is the services sector, which is there in purple, and the manufacturing sector, which is there in the orange line. Just for reference, any number that is above 50 means that that segment of the economy is in expansionary territory. If that number is below 50, as is the case with the manufacturing index, that means that the economy is in a contractionary phase. So what is this telling us? Well, I think, as the title suggests, we've kind of been here before, where the manufacturing sector does tend to be very sensitive to broader macroeconomic variables, and therefore it's going to be a bit more volatile. You can see there have been periods in time, if you just extend it back over the last 10 years, where you would see, the manufacturing sector in contraction. So in the period right before COVID, the manufacturing sector was in contraction for a good amount of time before COVID actually hit. And then back in the 2015, 2016 timeframe, this was around the time when Europe was still dealing with some of the issues relating to Brexit, but also some of the PIGS or debt issues that Spain, Italy, Portugal were all facing at the time. However, I did want to just point out that the larger part of the economy, the services sector, which comprises somewhere between 70 to 80% of the total economy in the US, is now back in expansionary territory. So even coming off of 2021's pretty spectacular growth phase, relating a lot to stimulus packages and the 2 to 3 stimulus packages that we received post-COVID, in drawing down, we did resume our upward trend in services economy expansion, whereas manufacturing has continued to decline. So I wouldn't make too much out of the manufacturing decline. The one we're really paying attention to is services, and by all accounts, even though the bond market is signaling a recession on the horizon, the services sector isn't necessarily reflecting that outcome at the moment. The other thing I wanted to touch on, and I do realize that this word collapse is probably a little bit inflammatory, so I'm using it a little bit in jest here, only because the punchline, I think, is that the economy, or the housing market, which is a very sizable part of assets owned by most individuals, is declining in a year-over-year rate of change. It's still growing at a 10% clip, even with mortgage rates above 6%. And so I think really the takeaway here for those of you that tuned in to 2 Minutes with Todd on Monday, my point in showing this chart was that, much like many other assets that have deflated post-COVID, we're likely going to return to more trend level of growth, which for the housing sector should be really no more than the rate of growth in the economy, because it's supported by incomes. And if you look at where that might be, it would land somewhere between that 2 to 3% longer term trend line. Now, obviously, this is a trend, it's an average, and rarely is it the case that markets return the average rate of return. But I guess the point is that I don't see any reason for the housing market to collapse, because yes, while demand is being sucked out of the market a little bit with interest rates rising and by extension mortgage rates rising. Supply continues to be an issue and a constraint across a number of markets. I'm not talking about like, gateway markets like San Francisco or New York. Those are always going to be areas that have heavy influences with international buyers, but maybe second tier, third tier markets continue to experience supply constraints around affordable housing. And that I think will provide a bit of a floor going forward. Looking at what's recently been reported in inflation, we got the October numbers for inflation just a couple of weeks ago, which led to sparked a bit of a rally in the equity markets. And you can see where we've landed with the rate of change for the year-over-year increase in CPI. Month over month, CPI has came in at roughly a 7.75% or 7.7% inflation rate. Actually, I'm sorry, that should be year over year. What is this really doing to this orange line? The orange line is the rolling 12-month average of CPI. That's the line we really need to be focusing on, because this is going back to some of the research we've done around certain levels of CPI and stock price multiples. Once you get below 6 is when we start having favorable action or activity within equity markets or financial markets, because 6 is a much better or easily adjustable number, or a number that can be used much more easily than a number that's above 6. So we're still looking at middle June, early July as the point at which the rolling 12-month average for CPI gets below 6, which in our opinion should be about the time when markets have dealt with whatever recession that's in front of us and could be mounting a bit of a comeback relating to earnings and eventual earnings growth. Then finally, just a quick update on where we are with the US dollar. This has been a very key variable to watch because it does have a big influence on global liquidity. And what you can see here is that commensurate with a rise in equity markets, maybe because of the rise of equity markets, or maybe it's the other way around, the dollar index has gone down, which means international currencies have gone up versus the dollar, because it's all a relative game, and by a pretty decent amount. So while we were hesitant to say that the dollar strength trend has lost steam, it definitely has been helpful for asset markets, because it's easing global liquidity conditions, and therefore if global liquidity conditions are easier than in previous periods, that will lend itself to positive performance for our asset markets. So we continue to watch this very closely, because also this a weakening of the dollar after coming off such big strength could be a trend change that we want to be mindful of, and that would also be a trigger for us to be considering larger allocations to international equities or bonds, for that matter, down the road. And I do think this is important because we laid this out maybe 6 months ago because we were noticing there was quite a bit of negative sentiment in markets at the time. This is back in June or so. And we asked the question, well, what could go right? And certainly the markets had more downside to go between June and September. The market, S&P bottomed in September, right around September 30th, actually, and has been on a one-way rocket ship up since that time. But areas that we thought could be available for some upside catalysts, certainly a reversal of the very negative sentiment that certainly occurred. A compromise tax bill that was passed, actually, if you recall, in the middle of the summer, at least through the House, to get ratified by the president at some point. But another one of our X's have actually occurred, which is that inflation is, with the last October print, is now start declining a bit faster than the market had expected, which is exactly why, number one, we can't stay out of the market because we don't know exactly how inflation is going to evolve and at what pace. But if we do get these upside surprises, that can be a pretty powerful catalyst for upside prices in markets that we want to have exposure to, so we won't be underinvested. A big catalyst on the horizon I still see as feasible at some point in the not too distant future would be a cessation of conflict in Ukraine. Certainly, I think Europe is growing tired of having to deal with this conflict on their eastern border, Energy issues are going to be even more acute, looks like in next winter than in this winter. Turns out actually Europe has had much more mild of a winter already than the trend or historical averages would have suggested, as well as because of that, they were able to stockpile or store a lot of their underground reserves for natural gas. So they're in a pretty good spot actually as far as heating energy is concerned for this winter. Next winter, and actually gas for the industrial sector into next year is still very much a big question mark, because you can only backfill so much of the gas supply with gas supplies from the US versus Russia. So we'll just have to see how that evolves. But those are some reasons why we think there could be some light at the end of the tunnel on that front. But fingers crossed, of course. So let's see how this translates into our 2022, the rest of the year outlook, and maybe a little bit of 23. So we do have a few things to note here. And for those that are just tuning in, we made some of these shifts after our Q3 investment committee as we made our way into Q4, but certainly having or upgrading versus the large cap stocks, both the small and mid cap sector. We do have some exposure there across almost all of our accounts now. Particularly with some of the tax loss trading we just did. That's one shift, or maybe one minor shift that we've accounted for within our portfolios, is adding a small position in midcap and midcap index into our portfolios. Still have a little bit of an underweight to international stocks relative to our target. We still have a small position, about a half of a position that we normally would have. But again, if the dollar continues to sell off, that'll only provide a bit of a tailwind for international stocks. And keep in mind that they are starting at lower valuation multiples than the US. So that could also be an area that we add to in the not too distant future. One thing we have added to since Q3 would be short, and I want to stress, short duration government bonds, high quality corporates, and municipals. More recently, you'll see in a moment here some of the changes and shifts we made, but at the end of November, actually middle to end of November, as interest rates were coming off their most recent spike up higher in the 10-year from about 4.25 down and through 4%, we decided to trim off some of our index or active core strategies that have longer durations in favor of additional ultra short bond ETFs. And what that does is it just keeps our interest rate sensitivity low. And also it allows us to benefit from the inverted yield curve, which means that the short-term yields are higher than long-term yields. And so we think that's a pretty good place to stay at the moment. We still have no exposure to junk bonds, high yield bonds, even though they've been very not attractive, but they've been very popular with investors. I was just looking at investor flows over the last few weeks, 3 weeks, and junk bonds have taken in a lot of new capital, which have kept spreads quite tame. But we still think if there's a recession on the horizon as a potential, then why even take the risk? Emerging market debt, similar situation. The yields just aren't high enough yet for us to get very attractive. And then finally, still have a preference for alternative strategies, whether they be liquid or illiquid. On the private side, most of those strategies have done exactly what we had set out to do, particularly for the income generating side. For liquid versions of our alternative strategies, those have performed, of course, better than the bond market in this quarter, doing quite well as a follow through from Q3. So we feel really good about that. It was a question from a client that I think is a really legitimate question to say, all right, well, at what level do we, take out the alternative exposure or the liquid alternative exposure and go back into bonds? Because, at some point, if the treasury yield is at an attractive enough level, or corporate bonds are at an attractive enough level where we're getting those adequate returns, then we just don't need to take on the risk of an alternative strategy. And I would say it's a fair point. The level we're targeting for a short duration treasury position or corporate would be somewhere between, call it 5.5%, 6%. And so we have changed a few things on this portfolio of themes, although there's some things that remain the same. Just going back to, you may have heard of the phrase TINA, which stands for there is no alternative to stocks, we think that period is ending. So yes, longer term stocks will generally have a higher return potential than bonds will. But we have to be mindful of the fact that over various periods of time, sometimes that calculation will be different. When bond yields are like in the early 80s, when bond yields were 10, 12, 15%, that would be a really interesting and attractive level if we could find that in the markets right now on the bond side. We're nowhere close to that, of course, but we just need to be mindful of that. So that's really kind of the point of this, is to say we are keeping an eye on what's going on with bonds of various types, and we will make shifts proactively if we can get plan level returns and locking that in without a lot of equity risk. We continue to think that we are going to see better returns on the horizon. Why is that? Well, it goes to your question. Thank you for asking that. Your question was, do you believe that come January that there will be a major sell-off in equities? I think the market is definitely not really accounting for accurately the decline in S&P earnings that are in front of us. Not to say again, I don't want to use the word collapse, because that is a very loaded term. But it's certainly, I think that earnings in S&P are set to come down because we have record high level profit margins that are trending lower, that need to trend lower based on a number of macro variables in the economy. So that therefore, if we have lower earnings and the multiple stays the same, then we should be in having lower markets in store, at least over Q1. Not to say that's going to happen, of course, because there could be some upside surprises to earnings that we're not accurately accounting for, like lower labor costs potentially, which is maybe a variable not many people are talking about. But that notwithstanding, I would say we continue to believe that there's going to be this sideways choppiness to markets. So we're kind of near the upper end of the more intermediate term range, probably moving back into the middle of that, which would mean a little bit of downside for Q1 would be what our expectation would be into the first part of next year. And then as earnings kind of trough out, we have the recession behind us, will be when the market can start to march higher. It does speak to what we think 2023 will be, which is a big transition year for markets, where you have a very steep decline in inflation potentially. Now we'll see if that actually happens. That's what the consensus is. But if we have any wobble in that, meaning that inflation will stay higher for longer, which is likely going to be the case in our opinion, then we need to position accordingly. And that's part of what this new block down here is meant to convey, is that I think we need to update our playbook about how we have to account for a higher level of steady state inflation, because the old days of 2 to 3% inflation are not likely going to be here for a long time, and we need to account for that within the way we're investing. So again, having migrating ways we can do that would be pivoting maybe more to what they call value stocks versus growth stocks. That would be one way to account for higher inflation, because those are shorter value stocks are shorter duration. They also have higher dividend yields. The other way would be to have a short duration of your bond portfolio, and also incorporating maybe inflation protected bonds in there as another option. And then looking at things in the commodity markets with energy exposure would be all ways that we're maybe learning to adapt the portfolio to deal with higher levels of inflation. So this is all what that's meant to encapsulate. Year to date, this is the picture of the equity markets through yesterday evening. So you can see we've had what I think is a really important rally in tertiary markets, Chinese markets, from a number of market matters ago. I think I pointed out Chinese markets have led U.S. markets both up and down over a variety of different major turning points, financial crisis, the Q4 sell-off in 2018 that was precipitated by a devaluation in the Chinese currency. And also this year in July, Chinese markets started to turn lower when other markets were moving higher, only for other markets to move back lower. So the fact that we've had a big rally in Chinese markets off their lows more recently, that's coincident or maybe on top of the Chinese Party Congress election, I think is a big positive sign for markets that maybe we're getting some positive momentum now at our sales. I did just want to point out, while there is, some positive things on the horizon, the equity market in the U.S., at least the large cap segment of it, continues to be a little on the expensive side. So the average, this is the forward-looking PE multiple of the S&P 500 over going back to 1976. And you can see a few things here. One are the peaks that coincided with large multiples, which was year-end 21, and then, of course, year-end 2000, both consistent with a similar multiple, with a derating that followed. So I don't necessarily think that we're going to see the derating that occurred here from 2000 into 2008, but likely at 17, it's we're looking for probably a sideways market as earnings resume an uptrend at some point later in the year, and a multiple that's consistent around this area or maybe a little bit lower, which is one reason why we've had a modest upgrade to the mid-cap space, because that multiple has derated pretty significantly. And with that as a backdrop, we feel like there's some decent opportunity there now. I did show this chart, apologies, and it came through and I saved it a little grainy. But one of the ways I was mentioning we can deal with inflation is through one way to deal with that would be in the equity side, looking at more value-oriented opportunities or sectors versus growth-oriented sectors. And what this chart's meant to show, for those that didn't see it on the 2-minute segment that I had either last week or week before, is that when the difference in growth value, not saying either is outperforming the other, but when you have these very large shifts between growth and value on a constant basis, number of days in the year, that tends to be a pretty decent indicator that we're approaching a turning point from a style perspective. So whatever style was dominating going into this transition period will likely be the underdog or the laggard in the next phase of the regime shift. And so, of course, what was dominating style-wise from basically 2010 to 2019 was large cap growth. And by extension, if we believe we're approaching or on the other side of a turning point, then large cap value should be the dominant style as we exit this turning point, this phase. So we certainly are aware of this. We have active strategies that do have more of a value orientation and a tilt. In our core equity strategies that are index-based and fund-based, we have added things like resource allocations, natural resource allocations that are more value-oriented. So we're certainly shifting in that direction, not hugely, but small shifts can be very meaningful. And this is just another version of that chart that I just shared, showing when the paradigm shifts or when the regime shifts, it tends to stay that way for quite some time. So what you're seeing is the difference in return and value versus growth. So if the line is going up, that means value is outperforming growth. And if the line is going down, that means growth is outperforming value. And so we just came out of a period potentially where growth is outperforming value. And now we're potentially going in the other direction where value could outperform growth for some time. Moving to the fixed income market, this has been the real surprise sector for a lot of portfolios, including us. We definitely didn't think that things like the long bond, even though we have no exposure to long bond, could be down over 30%. Our way of accounting for that as a possibility was to not have any exposure to long bonds in any shape or form. But you can see, how this has evolved. Interesting, the muni market, municipal bond market has held up quite a bit better than the aggregate taxable market. So, we've been having allocations and increasing those weightings to the muni positions over the course of this year. And that seems to be, a pretty good place to start adding back with rates where they are at the moment, particularly as we approach higher tax regimes in the future at the federal level. But you can see here, we're not taking a lot of interest rate exposure, which is proxied by this pink line. We're not taking a lot of credit exposure, which is actually proxied by this light blue line, or even this green line. So I think you add it all up, our fixed income performance has done quite a bit better than the index, but one that we'll have to just keep an eye on and evolve as time goes along. One thing that is a bit troubling about the recent rally in bond yields, this is a picture of the 10-year bond over the last 12 months. And you can see we started off the year call it January at 1.25, I think it was, maybe 1.5, rallying all the way up to 4.25 at the early part of November, only to come right back down to 3.5. And one thing I would point out would be that the performance or the buildup in bond yields isn't very consistent with what's going on within the macro variable market, meaning inflation. And you can see I've plotted that right behind this chart, because at CPI at 9%, bond yields were right about where they were at 3.5. Now that CPI has declined a little bit to 7.75, they're still trading at 3.5, which just suggests to me that there still is a bit of a bias to the upside, because even though yields were rolling over a little bit during this phase, going from 9 to call it 8.25, 8.5 or so, sending yields down a little bit, it appears that we're probably in one of those short give back moments on the bond side, only to set the stage for another move higher in yield. So we don't want to be too aggressive with our bond positioning. In fact, as I just mentioned, we're being very conservative. So this is just something that is a bit of a bugaboo in the back of my head right now, because the activity in the bond market isn't necessarily suggesting that we're in the clear yet. One thing I did want to point out that's really just interesting to note is that alternative strategies, and this is something I've been mentioning for a bit of time now, alternative strategies by and large tend to do better on average, using these indexes down below, when interest rates or cash rates, meaning 3-month T-bill rates, are higher. So this is also one reason why we're going to be pretty selective if we do decide to reduce our liquid alternative buckets, because as you can see, in a lot of cases, the performance potential for alternative strategies gets a lot better as rates rise, because when rates are rising, that means there's more volatility. There's more of a starting point for your return profile than there was previously. And this is just, I think, a really powerful set of data to just suggest that, we should be seeing better return profiles out of the alternative buckets now that we've got a good starting point with our cash bucket. And then this is just a summary. You can see here what I was mentioning, some of the shifts we made more recently out of the investment committee, and the last one going from about a 25% in ultra short bond ETFs to about 40% of our fixed income exposure in ultra short bond ETFs. So this has been a pretty active year, one that I think has been a bit tricky to navigate, but certainly we're not out of the woods yet, and we'll continue to make shifts as appropriate. And then, I basically summarized most of these with comments along the way. I did want to get to the final piece here, which we won't spend a whole lot of time on. I'll reserve that for our January market matters, because that's going to probably be a little bit more of an encompassing look at 2023. But I just did want to give you a general sense of how we're looking at what they call asset allocation or portfolio construction, because it's really important to understand how this has evolved over the years and maybe where we could be going in the future. And I'll just summarize it with this one chart first, and then we'll dig in more in January. But basically, when I started with the firm in 2008, 10-year bond yield was at 3.75%. And our portfolio looked pretty similar to a benchmark 60-40, where we had a little bit in cash, but roughly 38 to 40% in bonds and about 60% in stocks. But as the yield environment has changed, and this is a subtle nuance that maybe it has to do with the fact that both Hank and I have fixed income backgrounds. We were studying asset allocation policy along the way here with the investment committee. But we have been carving out portions of our fixed income exposure, because the reason that fixed income exists in a portfolio is for two functions. One is for income generation, the other is for capital preservation. And when the 10-year bond yield in 2016 started to dip below the rate of inflation, the mandate of that it basically flipped from from income first, capital preservation second, to capital preservation first, income second, because we didn't want to be reaching for yield. So this is why we put a lot of effort and time into understanding what was available on the liquid and private markets side of the investment opportunity set. And this is why we started to carve out incrementally larger portions of alternative and fixed income from fixed income, to the point where you see today in January, where the recommendation for a 60-40 was roughly, call it 20 to 25% alternatives, a much smaller portion, call it 10 to 15% in fixed income because of the very low yield we were starting off at, and a slightly higher percentage in cash because now cash was actually yielding a decent amount of yield versus coming into the start of the year, which was 0. One thing I would note, though, is that we do believe that having a pretty static exposure to equities is generally going to be the approach we take, because being uninvested or underinvested in either a bull market or even a bear market for that matter can be a very precipitous or dangerous position to be in, because then you're engaging in market timing decisions of when to get back in, which can be exceptionally difficult to be able to identify, because it's never going to feel great to add back to a equity position that you're way underexposed to. And our position has always been, well, we're going to approach that with rebalancing, also making some style decisions if we need to, growth versus value, or US versus international. There's a lot of decisions to make within this equity bucket that go into exactly how we're going to approach that. And I've kind of laid out a little bit of some of those decisions today, adding to mid cap, maybe adding more to value exposure as we get closer to the end of the year. So I just wanted to give you a rough sense for how we put some of these pieces together. There's actually a lot of data and discussions that happen behind the scenes, as you might imagine, but I just wanted to kind of frame it out for you here to give you a sense of what we're looking at and what we're doing behind the scenes. Okay, that's all I had prepared for today. So I hope I've given you a good idea of what we're up to. Look forward to seeing you in January. That's going to be a little bit longer of a webcast. That's going to be where we're going to introduce the capital market assumptions for 2023. And I look forward to seeing you then. Thanks, everybody.